Okay, we're going live, and just make sure everything is up. I'm going to be talking. Here we go. Looks like it is live. Perfect. All right, guys. Thank you for joining. I appreciate anyone who gets in on this live chat with me. And we're going to basically just go over a few things. So it's been a long time since I've posted on this channel, and I figured it's time to post something. Luckily, today we did have a good market. Let's see. Let me just throw new to this live situation with this software, but here we go. I got it. All right. So the S&P today was up about 2%. Market's closed now. It's 7:40 p.m. Eastern. But obviously, anyone who's been in the market knows that there's been some pain. Year to day, we're basically down 15% or so. And it's been a rough market to say the least. Now, I wanted to go over Disney because I've obviously promoted a lot of Disney videos as far as the stock. I'm very bullish on it. I have a large position in it. I continue to be adding to my position. I buy stock in Disney almost every day as it's been going down. But I believe in the long term. So they recently had their Q2 earnings, Q2 2022. So I pulled those up just so we can go over it, kind of break it down live. And if anyone has any questions, we can answer them, on the live. So getting into it. First, they reported that, our strong results in the second quarter included fantastic performance at our domestic parks and continued growth of our streaming services. 7.9 million Disney Plus subscribers are added in the quarter. Total subscriptions across all their direct-to-consumer offerings exceeding 205 million. So once again, they proved that they're in a league of their own, is what Bob Chapek said, which is, he's specifically pointing out basically that even though Netflix in their recent earnings report lost subscribers, Bob Chapek, the CEO of Disney, basically believes that Disney really is in a league of its own because of the content, the IP they own, etc. So rather than a loss, they obviously gained 7.9 million subscribers for Disney Plus, and they're over 200 million now, at 205 million for total subscribers. They go on to say, as they look ahead to Disney's second century, I'm confident we'll continue to transform the entertainment by combining extraordinary storytelling with innovative technology to create an even larger, more connected, and magical Disney universe for families, fans around the world. So let's get into the numbers. So I'm going to break it down to the different segments. So let's first go over Disney's media and entertainment distribution. So basically, this is broken into linear networks, direct-to-consumer, content sales licensing, and you have the revenues up here, and then you have the operating income here. So linear networks, their cable, basically their legacy business before they move into direct-to-consumer is doing extremely well. In the quarter, they did $7.116 billion of revenue. This is up 5% from a year ago, which was $6.746 billion. Their direct-to-consumers, obviously, their high-growth business that people really are looking, to the future for this company. One of my entire bull thesis is basically around streaming. So they did $4.9 billion in this quarter, up from $3.99 a year ago. That's a 23% increase in their revenue year over year. And then content sales, licensing, and other, $1.866 billion in revenue, up from 3% from $1.916 billion a year ago. Some eliminations, but basically total revenue for Disney, their basically media and entertainment portion, not including parks and everything, we'll get to that after, was $13.62 billion, which was up 9% versus $12.44 billion a year ago. When it comes to the bottom line of that, the operating income in linear networks, that's where all their profits really coming from. For the media segment, $2.815 billion of profit versus $2.849 billion. So basically about the same from a year ago. Which is good because we want the linear networks to keep providing cash flow as they build out their direct-to-consumer business. So the direct-to-consumer business, not so much, had a huge loss, $887 million, but we expected that. They have said multiple times since they basically announced Disney Plus, they've talked about how they don't expect it to be profitable until 2024. And it's because there's such a low Arpu on it, average revenue per user. But right now it's just about getting as many users as they can get, expanding it as much as they can, and then they're slowly going to raise prices, and obviously profitability will come with that scale. So they took a much bigger loss And then from content sales, it's very minor, $16 million of profit versus $312 million a year ago. So it's obviously the biggest reason there is they're not licensing as much content now that they're keeping it for their direct-to-consumer platform. So their bottom line on the profit for the Disney media and entertainment distribution portion of the business was $1.944 billion versus $2.87 billion a year ago, so down 32%. Now, their overall income is up, and that's largely to do, which we'll see, that parks have came roaring back. Now, when we look, they do give you more information as far as like in their linear networks, domestic channels versus international channels. Obviously, domestic channels have a lot more revenue as well as income, $2.3 billion of income, whereas, $1.2 billion revenue on the international, $245 million on the international's income. But basically, linear, I'm not looking for linear to grow like crazy or anything like that. I'm looking for it to just keep providing cash flow as the direct-to-consumer business grows revenue and then eventually grows the bottom line. So as we go down and we go past this, we'll get into the direct-to-consumer numbers. That's pretty important here. So we're looking at basically subscriber numbers, and we're looking at Arpu, so average revenue per subscriber, per user. So for Disney Plus, they give us a lot more info now. They break down domestic, they break down international, not including Hotstar, which is obviously cheaper in places Southeast Asia, India, things like that. And then they give us Disney Plus Hotstar on its own, and then obviously total Disney Plus when you add it all. So for Disney Plus domestically, US and Canada, we're at 44.4 million subscribers. This is up from 37.3 million a year ago. That's almost a 20%, 19% increase year over year in subscriber count. So that's a really healthy growth. For their international subscribers, excluding Hotstar, so this is a key metric because Hotstar is obviously a much lower ARPU, it's 43.2 million, which is up 39% from the last year, which was 31.1 million. So huge growth there. And then you combine those, basically everything but Hotstar. Disney Plus is at 87.6 million, up 28% from 68.4 million a year ago. Then when we're looking at Disney Plus Hotstar, they have 50.1 million subscribers as of the most recent quarter. This is up from 35.2 million subscribers, up 42% year over year. So huge growth, even higher growth than any other segment. And obviously that's going to be lower ARPU, but it's basically, the future. There's over 1 billion people in India. It's a massive market that you want to win if you're a massive global company. You want to be there as that market grows. So total Disney Plus subscribers is at 137.7 million subscribers. This is up from 103.6 million a year ago, basically a 33% increase in subscriber count. So that's a lot of additional subscribers coming onto the subscription for Disney Plus alone. That doesn't include ESPN Plus or Hulu, which now we'll get into. ESPN Plus is at 22.3 million subscribers. This is up 62% year over year from 13.8 million. Now, ESPN Plus is still very small in comparison. I mean, it's huge as far as numbers. 22.3 million is not a small number in any way, but it's still holding on to so much of the content from ESPN is still on the linear networks. And Bob Chapek has talked about it on the earnings calls. Questions always come up about it. He basically says, look, we're 1 foot on the boat, 1 foot on the dock in terms of putting all our, sports straight to subscription because there's so much money coming in the linear network. And they need to kind of just play it by ear, watch as subscribers go up, as they raise prices, they just keep putting more and more content and they'll keep growing it. And it's obviously working for them. I mean, 62% increase in subscribers in 1 year is a huge number, and they obviously are putting more content on the platform, but there's still a lot of content, football, things like that are not on the content on ESPN Plus that would add tons and tons of subscribers, I think, as they continue to add those things. Now, when it comes to Hulu, Hulu has 2 different services. They have the SVOD only, and they have the live TV service, which comes with also their SVOD service as well. So SVOD only is 41.4 million. That's up 10% year over year versus the 37.8 million. Keep in mind, Hulu is only a domestic player. It's not, they don't use Hulu globally. Globally, they use Star as their brand for adult content and whatnot, which is kind of attached to Disney Plus in Europe. It's on its own as a bundle with Disney Plus in Latin America. And it's basically just the only place it doesn't exist is in America. We use Hulu instead. So good growth as far as Hulu domestically, 41.4 million is a lot of users. And then when we look at their live TV, which is a much higher ARPU, that people spend a lot of money on that, it's 4.1 million subscribers versus 3.8 million a year ago, so about 8% increase there. Now we look at the ARPU, and this is the most important thing because at the end of the day, you have all these subscribers, but how much are you making from them? And we know Disney Plus is soon going to release a advertising tier. We know that with Hulu, advertising is actually doing extremely well. They make a little bit more money through the ad people that pay less with ads than the subscribers that pay more without ads. So, and with Disney having, huge branded content, Star Wars, Marvel, things like that, I think, advertisers are going to pay top dollar when that does come out. But that is not yet out. That's not part of the ARPU yet. So Disney Plus domestically is making $6.32 of average revenue per user versus $6.01 a year ago. So it's a 5% increase. This number, I don't expect it to go, huge anytime soon. I think it's a slow increase. You could see, I've talked about it in past videos, how parks, basically, the ticket to go to Disney World has went up every single year since it's come out, pretty much. And it's went up dramatically, much higher than inflation. And I expect the same for Disney Plus content. I think this price is going to go up every single year. And they're going to make a ton of money doing it because if you want to watch the new Marvel movie or this or that, this is going to be the only place to do it. And you're going to obviously have your entire library of all movies they've ever made. Now, internationally, they're at $6.35. This was a huge jump from the $5.14. It doesn't sound like a lot, but since we're talking in small dollar amounts, it means a lot for revenue because it's a 24% increase for their revenue per subscriber. For total subscribers, 24% increase in revenue. Now, Disney Plus as a whole, when you average out domestic and international, but you don't include Hotstar, it's coming in at $6.33, which is up 13% year over year. Disney Plus Hotstar is obviously what I was saying, extremely, extremely cheap service. It's offered in places like India where you're competing with I believe they pay like $2 a month for linear networks. So very, very low end price point, but obviously increasing fast. For example, a year ago it was 49 cents. It's now 76 cents. Now it doesn't seem like a huge change in as far as dollars. It's only some cents, but it's a 55% increase in the revenue they're actually getting from that service. So it's a huge jump in revenue, and you're talking about a ton of subscribers. And an extremely fast growing subscriber count. So global, when you take all those things into account for Disney Plus, we're at $4.35, still an extremely small number. When you're looking, I pay myself $20 or so for Netflix. So when you're talking about where are they today versus where can they be in the future, $4.35 is extremely low ARPU, and I think it's going to get significantly higher. I think, eventually people are going to be paying $20 or so for Disney Plus. Now, this is up from $3.99, so it's about a 9% increase year over year in revenue across the board. For ESPN Plus, we're at $4.73 as far as the ARPU. That's up 4% from a year ago at $4.55. Hulu's at $12.77. This is up 6% from a year ago at $12.08. And when we say these numbers, up 6%, up 4%, that's not the revenue. It's per subscriber how much they're paying additional. So 4% increase in the actual amount the subscribers paying every single month. So as far as Hulu, it's $12.77 versus $12.08, so 6% increase. And as far as live TV, it's now $88.77 versus $81.83, an 8% increase. So it's interesting to see how even linear networks like live TV is going up in price year by year. It went from $81 to $88. So while that's rising, people say to me sometimes, oh, $20 would be too expensive for Disney Plus or for Netflix, or $30, $40, whatever it is. But people don't realize people are paying $88. You got 4 million people paying $88 for a service that's not a global, this Hulu Live TV is a domestic service, and it's competing with a lot of, most people aren't using linear. They're using subscriptions now. But at least new people signing up. So, and Hulu Live TV is fairly new versus the legacy companies. So people pay a lot of money for linear networks, and I don't see why in the future people wouldn't be paying that for subscriptions when it's a better service overall. It'll be, watch what you want when you want it. So I do see, obviously, the Arpu going up across the board, and as we can see in this quarter, over the last year, it did go up across the board for every single one of their services. So next we get into the parks. So as far as parks and experiences, domestically, their parks did extremely well. We're talking over 100% growth. The parks were obviously last year not doing as well, extremely limited on capacity. But domestic parks came in, I knew it was going to be a huge number, and it came in at almost $4.9 billion of revenue, which is a massive number. Internationally, there's still problems with shutdowns and things like that, but it still did $574 million in revenue. And then consumer products, which is huge margins, licensing their IP for different types of products, came in at $1.18 billion of revenue. Total revenue for that quarter, keep in mind, this is just quarterly. It's not annually. So this is the last 3 months, $6.652 billion of revenue. Now, when you're looking at the operating income, how much they made, domestically, that $4.898 billion actually translates to $1.385 billion of income for them. So a ton of profit in the quarter. Then we had a loss internationally because there was a lot of, they weren't open the entire quarters at all their international parks, a lot of limited capacity and things. Shanghai's not open right now. There's a lot of different things going on, but a loss of $268 million. As we start to see things fully reopen and whatnot, parks are going to be, I think, roaring. We do know that they've said, Bob Chapek has said domestically, as far as when someone comes to the park, they're spending 40% more per capita. So when you go to the park, you're spending 40% more on average than you were spending in 2019 before everything. So the amount of money they're going to be making at these parks is going to be ridiculous. It's already extremely high. They're making a lot of profits, but it's going to get even better. Now, when we look at consumer products, on that $1.18 billion of revenue, they did $638 million in net income. So it's tons and tons of profit. It's a high margin because it's licensing, basically. So that's basically the parks. That's the linear. We'll look into a couple other things. Let's just pull up the stock. Let me pull it here for us, and we'll kind of break out where it is. So I'm very happy with the earnings report so far. And let's look at some of the metrics where Disney is. It's $108.64 right now. It was up 3.3%. I personally think this is extremely cheap, sitting at close to the 52-week low. It just was $100 or so a couple days ago, 2 days ago or so. But as you can see, year to date, we're down 30% on this stock. So, it's down a lot. It's down in the last year, 36%. Almost any big company as big as Disney, that's not a new company that just IPO'd or this or that. We're talking like big, great companies that have been around for a while, are the best at what they do, etc. Even though they're down because the market's down, if you looked at a 5-year period, not a 1-year period, they're usually up. And for Disney, it's the rare case that it's basically not. 5 years ago, this stock was basically the same price it is today. It's up 1% because of today's day up. Yesterday, it was actually down. So we're talking about not making any money on a stock that's been, for the last 5 years, growing. Obviously, we had a huge problem in 2020, but for the last 5 years, the company has been growing its businesses across the board. It didn't have Disney Plus at all, and now it has one of the best, if not, I think will be the best and most subscriber, most Arpu down the road for its subscription business, a huge business that didn't exist. If you take any other company that's a big company, it doesn't matter that it's down or not, and you look 5 years for it, pretty much all of them, let's take, it really doesn't matter, but let's say Amazon, I know the stock is down right now, not today, obviously, but overall in the last year, it's down 30%. But if you look at the last 5 years, it's obviously up 140%. It's up huge. So even though a lot of stocks are hurting right now and are bad, in the grand scheme if you held it for not just the last year, you're up a lot. But Disney's in the rare case where it's one of the best at what it does, and it happens to actually be break even in the last 5 years. And I think there's a lot of opportunity going ahead because 5 years ago, streaming didn't exist for them. pretty much. Disney Plus didn't exist. And I think that provides a lot of opportunity. Now, when people look at PE, this is a little misleading because this is still kind of taking into account the fact of a lot of their parks really weren't running at capacity. Disney's a lot more than just a streaming service. Disney basically has, it has cruises, which are going from, there's currently 4 cruise ships that they operate, which are still getting back to capacity. But I took a cruise with Royal Caribbean about a week ago, and it was packed. You wouldn't have thought, anything has changed. The cruise lines, the cruise business, I think, is booming now. It's starting to really go great. I've watched a lot of cruise company CEOs talking about how they're having more demand than ever now for the second half of this year. So I don't expect, with Disney especially having such a smaller amount of ships, I expect them really to get to full capacity before someone like Royal Caribbean or Carnival with 20 cruise ships gets to capacity. Disney with only 4 cruise ships will be able to fill those rooms quicker, I think. Now, Disney's going from 4 cruise ships to 7, with their 5th cruise ship coming online in about a month from now. So we have their business, their legacy business, cruise ships, hotels, all of that growing and making tons of profit while they build the streaming business as well. So we're getting a stock that is basically break even for the last 5 years. That is growing all cylinders as far as their legacy business. Their linear network's doing great, very little growth, but lots of profit. Their cruise business is basically going to double, 4 ships to 7 ships. Their hotels, they keep opening up more hotels and cool experiences like the Star Wars hotel that is extremely expensive and completely sold out for the next 2 months or so, 3 months. So there's a lot to like about the legacy, and then you have the entire streaming business, which if you do some simple math, and I like to say this, if you pull out a calculator, just you can do it yourselves while you're watching this video. If they're at 205 million total subscribers across the company. Now, I don't think it's, there's about 3 billion or so people, or 4 billion people that use Facebook. And to use Facebook, you have to have internet access. I don't think it's going to be that hard to believe that there's going to be 1 billion people subscribed at some point. But even if I'm wrong, even if it's half that amount, if they hit 500 million subscribers, we're talking about basically, we'll do the math together, 500 million subscribers paying, let's just call it $10 a month. So we have 500 million subscribers paying $10 a month, which I think is going to be low. I actually believe the Arpu ultimately will be like 20, maybe 30, 40. Linear networks is $80. And obviously there used to not be $1 $100 billion company. Then there wasn't ever $1 trillion company. Then there was. Eventually, I think companies will be $10 trillion companies. Things keep getting bigger and bigger. But even at $10 a month, 500 million subscribers, that's $5 billion of revenue a month. Now, that's basically, if you take $5 billion a month, that's $60 billion a year. And obviously, they have to spend on content. Now, the thing is, the company makes profits paying for its operations. That means all the salaries of the CEO and all the executives, the rent they pay for their office buildings, they make these movies and shows already and all these things. They're making a profit with all those expenses already paid. But let's take into the fact the content expense, because if they're not going to have it on linear, or they're not going to put it in the movies or this or that, even though they'll still have movie theaters, they'll still be making money. They are going to spend about 30 billion or so, which is it's a lot of money. Imagine an Avengers movie only cost 250, 300 million to make, and that's the most expensive movie you can basically make. So how many of those can you make with $30 billion? You can make a ton of them. You could be releasing massive blockbuster movies every single month and still not hit a $30 billion run rate. But the reason is it's $30 billion is because sports rights are expensive. They're going to make a wide, they're not going to just release one massive movie. They're going to release a massive movie, plus they're going to release a ton of random shows, and they're going to have a huge, broad variety of content. But that being said, at the end of the day, if you have $60 billion in revenue and a $30 billion content spend, and then all the other operational expenses outside of content spend are really being covered for the most part by the rest of the business. Parks and all of that pays all the operations plus makes them a ton of profit. So that 30 billion at the end of the day, when they do hit these numbers, 500 million subscribers across the company with $10 a month Arpu, you're going to have about $30 billion hitting the bottom line. And $30 billion hitting the bottom line with a multiple of even 15. Let's say it's a P of 15. That's a $450 billion market cap for the stream, for just that net income, not including any additional net income that's made by the company. Their total market cap today is about $200 billion or so. Yeah, it's here, 197 billion. So they're under 200 billion. And, if you take these numbers and you say, hey, look, eventually by 2030, by 2035, it doesn't matter how far out, because in the grand scheme of things, if you're holding this investment for a long time, you can play this out. If they ever had 1 billion subscribers, and that 1 billion subscribers was paying them, $15 a month, and I'm just going to be a little crazy here to show an extreme both side how big it could be, then you'd have 15 billion a month in revenue. And if you take that 15 billion, that's basically a year, you have 180 billion a year. And if you had 30 billion of content spend, that's 150 billion in profit hitting the bottom line. And if you had a PE of 20, which is not unheard of, that's a $3 trillion market cap. Now, am I saying Disney's going to hit 3 trillion market cap? No, I'm not saying it's going to 3 trillion anytime soon or this or that. But is it possible that it's a $3 trillion market cap in 15 years from now, as world population grows, as people are paying more and more for things? $15 a month isn't going to be unheard of for paying for it. 1 billion people, when there's 4 billion people using Facebook, subscribe to the biggest entertainment company in the world. I don't think that's unheard of. So my point is, there's a lot of room to be wrong. I can be wrong by 70% and still end up at a much higher market cap than it is today. Now, you have to do the numbers that you believe. How much do you think they're ultimately going to make per subscriber, what their Arpu will be, and how many subscribers will they eventually have? And kind of, play it out. When I do the math, it's obvious that the market cap is going to be significantly higher than where it is today. And you still have the entire legacy business. I mean, this company was worth $200 billion or so 5 years ago before Disney Plus existed. So their legacy business is worth and will grow. As I said, double the cruise ships, things like that. Their business is growing. So I'm extremely bullish on Disney. My thoughts haven't changed. I haven't sold. I'm not selling the stock. I'm buying the stock up as much as I can. And that's basically where I stand with the company. I think it's an amazing opportunity here. And I basically wanted to share that and go live with you guys and just give you an update of where I'm at on it. Anyways, I appreciate anyone who's jumped in and saw the live, and this will be up on the page for anyone who wants to see it later. Thank you.